We do about 2 shows every week now at the FTSE Show, one every Monday and one every Thursday. And that gives us the capacity to review about 100 companies a year. There are about 1,400 FTSE-based companies if you go all the way down to the FTSE AIM markets, which means we are only ever going to scratch the surface of what is available to us. I've had a lot of emails from people over the last couple of weeks want to know, is there a way of finding out what are the companies that have ticked all my boxes so far? Rather than wait for episode number 60 before you eventually find out what some of these companies are. We have covered a couple of them, but there are a lot more 100+ companies out there. Listen, if you are interested in finding out about that, go to a website called thecleantrader.com. That is my website. And on there, click on Stock Picker. And for a very small, affordable fee, you can get access to all the companies, all the research that I've done on those companies. Pop over there, read up on it. If you've got any questions, just email me, chris@thecleantrader.com, and I'll get back to you with any questions that you might have. Today, we're going to take a look at the cruise line company Carnival PLC. Hey there guys, how's it going? Chris Chillingworth here, welcome to the FTSE Show. Please forgive the kind of salesy bit at the beginning. I'm getting a lot of emails from people asking the same question over and over again. Can they get access to this? So I just wanted to make it very clear, and this is the best way to do it because they're all going to watch this video. So it makes it the easiest way to kind of get that information out there. Today I want to take a look at Carnival. The cruise line company. Now, we are, at the time of recording this, we're slap bang in May 2020. I'm not going to say the CV word, the word we all know. I've heard 1,000,000 times over the last few months. The reason why we're all stuck in our homes at the moment. But Carnival have suffered quite considerably, and understandably, because they had many ships stranded with sick passengers when it all kicked off originally. They struggled to find places to dock. They had some real issues there, and obviously part of the travel and leisure industry as well. So this is a sector overall, especially with airlines and holiday companies, where there's just no revenue being made at all there. And so that's a concern. The Carnival UK arm, and we're looking just at the UK stock. They are the Carnival Corp over in the US are the main company, but there's a UK arm of that we're looking at today. The share price has fallen from £36 prior to let's call it the 1st of January 2020 down to £9.45 right now. So that's a huge drop in price value. In fact, the £9.45 takes us back to pretty much the same price as the 2001 float price. So they've rolled back 20 years in share price from this event happening. So yeah, there's two sides to this, because we're going to look at the financials, we're going to look at the underlying performance of the business and see whether or not it's a good company to look into investing in over the long term. But also there's price analysis to be done here, because the question will be, is this a steal at £9.45? What are you getting for your £9.45 if you were to invest in this company on a per share basis? And that's going to be something very interesting for us to look into. So let's not delay any further and let's dive into those numbers. Okay, let's take a look at Carnival, Epic code CCL. They are in the FTSE 100 and in the travel and leisure sector. So we'll go through the numbers and then we'll start to really look at whether or not this is potentially a good opportunity. The numbers generally will tell us everything that's going on up until the latest annual report, but obviously we need to take into account recent news. So that's something we'll do at the end here. But revenue has been growing over the last 4 years. We did see a period between 2011 and 2015 where it really didn't grow very far. So they obviously had trouble finding new business and getting more revenue into the company. But that doesn't seem to be so much of a problem the last 4 years, as we've seen it grow from 15.7 billion, and then every year we've seen it grow quite substantially up to the point of 20.8 billion a year revenue, which is awesome. And that is quite some good, decent growth there that we'd be very happy with as an investor. Looking at expenses, we can pretty much argue that that has been very consistent over the last, 12 years worth of annual reports here. Pretty much sticking at around 74%. I mean, we've had some peaks and some dips along that way, but on average, over the last 12 years, we're looking at about 74% of the gross profit being eaten up by expenses. It's relatively high, but it's well within the kind of threshold I'm looking for. 74% on expenses is okay. High, but well within the threshold. They've obviously got some depreciation costs, which we would expect from a company like Carnival with what they do with their cruises and cruise ships that they own. So there's going to be some depreciation in there, but it's not at a level that I would be too concerned with. And then we've also got interest on debt here. So there have been previous years where that's been far too high. Looks like they've taken control of that a little bit. We've seen the actual raw numbers here go down from there, but also because revenue's going up and gross profits going up, it's also helping these percentages drop off somewhat in terms of the amount of interest that they're paying relative to the actual gross profit that is increasing. So that's good as well, again, within the thresholds of what we're looking for, essentially. And then we come down to the net earnings. After all extraneous circumstances, sales of assets and all that kind of stuff has been taken out of it, we're just looking at the recurring everyday profit, essentially. And we can pretty much argue here that we've got about an average of 15% a year. And it's been quite consistent. It's the kind of numbers we were seeing at 2008 to 2011. And then we had that 2012 to 2014 period here where we dropped down quite a bit. That looks like it was more to do with the interest on debt that they were paying, which has now come under control in the last 5-6 years. And as a result of that, the profits are falling back in line. And they're doing pretty well. They're making, for every 21 billion that they're bringing in, they're keeping 3 billion of that. So pretty decent business on face value. Doing pretty well. Those are decent percentages that we'd be pretty happy with. Looking at the balance sheet, a couple of concerns here. The first concern for me is the current ratio is very low. What that essentially tells us is that the current liabilities, the liabilities due to be paid in the short term, within the next year or so, are much higher than the current assets that the company owns. So, and we can see that here, the current liabilities are at 9.1 billion. The current assets are only at 2 billion. So the main current liability here is other current liabilities, which is always, who knows what that is. You could dig and dig and dig and they still never find it out. So there's a lot of money sitting in there, which is, for me, I'd like to know what that really is. And why it's got to be paid very, very soon. So for me, that's a concern. It's not something as simple as tax liabilities. It's not something as simple as money that they owe other companies, i.e. accounts payable. It's not even something as simple as short-term debt. There's something else going on there. So I would want to investigate that first of all. But yeah, liabilities massively outweighing assets in the short term. That's a bit of a concern for me. It wouldn't necessarily keep me away completely, but I'd want to investigate that and find out what's going on there. And it's certainly a black mark against their name as far as I'm concerned as an investor. Looking at the non-current assets, the long-term assets, obviously a big chunk of that is in property, plant and equipment, 38.1 billion. These guys have got a lot of equipment and vehicles, and obviously their fleet of and obviously their cruise ships and stuff like that. And they've got some intangible assets in there as well. Looking at the long-term liabilities and, more importantly for me, the debt levels. Debt sits at 9.6 billion. It's fine. I mean, it's high, but bearing in mind their earnings capability of about 3 billion a year, when they're borrowing 9.6 billion, then you're looking at about 3 years to pay off that debt if they had to. Obviously, it's long-term debt, and it doesn't quite work out like that. The company aren't necessarily going to spend all of their profits on paying off that debt over the next 3 years, but if they need to, they could. And it's really just a measure of, are they biting off more than they can chew in terms of the debt level for this company. In the past, they have been operating at a level where they've been borrowing more than I would argue they should, based on their earnings capability. But now, where they are right now, with the earnings that they can bring in as of 2019, that debt level is okay. And then this is a figure that's going to come into play in a little bit. The shareholder equity. This is assets minus liabilities equals equity. How much equity do the company have? Well, 25.3 billion, which is very good. A very, very strong business there. And then again, retained earnings looking very, very strong. This goes up every single year. We can see down here it's just a sea of green, which basically means that the retained earnings pot has been growing on a year-by-year basis. There's obviously a focus there by the company that a certain percentage, shall we say, of the profits are being pumped into retained earnings, which is a strong thing to do. This might be that, they're raising capital to be able to increase their fleet. I mean, it gives them the opportunity to grow and gives them a load more options. As we come into 2020, this is going to play quite an important part, I imagine, in terms of the company. Looking at the return on shareholder equity, not as high as we'd want. That means the assets aren't working quite as well as we'd want them to in terms of bringing in revenue and profit. Bear in mind the amount of equity that this company has. We would expect to see the returns probably stronger than that, but it's a bit low at the moment. And they are also very big spenders when it comes to capital expenditure, which for me, I prefer to invest in companies that don't have to spend heavily on capital expenditure to compete and to do well. There is no going against the fact that this is a strong financial business. They're doing very well financially. But when it comes down to who I personally like to invest in, I personally like to invest in companies that have lower capital expenditure, better return on shareholder equity, and their balance sheet is a bit stronger in the short term. So for me, the way I invest, I'm looking for long-term growth. I'm looking for companies that are showing all the signs that they can grow over the next 10, 15 years and grow substantially. From what I'm seeing here, Carnival could be one of those companies, but I have better opportunities in front of me. I have a better selection of companies that are ticking all my boxes, and Carnival don't quite tick them. And so when you are presented with 50 companies that are all ticking all of the boxes, and then you have a company like Carnival who are ticking some of them but not all of them, it would make no logical sense to invest in a company like Carnival when I've got a nice selection of companies that do tick all my boxes. So that would be the only reason why I wouldn't consider Carnival myself as an investment for me and for my personal requirements. Then you have to take into account the events of 2020, because this is a travel and leisure company who operate primarily with cruise ships. Now, if you've been following the news, you'll know plenty about why travel and leisure companies are currently doing poorly right now. Specifically, cruise ships. And the question we need to ask ourselves if we were potential investors in a company like Carnival PLC is, what is the future of cruise ships? What is the future when the restrictions are lifted and people go back to their everyday lives? At the beginning of 2020, right now at time of recording this, it's difficult to perceive where that's going to go. I'm not much of a predictor, so it's even harder for me to try and work out what that's going to look like in terms of, will this company have much revenue? Will this company recover and get back on the seas and start filling those cruise ships again? Or will that be a long, long time away? I mean, a very quick and easy way of looking at the future for Carnival is we can look at, well, what are their expenditure? What are their expenses? We're looking at 15.3 billion a year to run that, to kind of run this business. Plus, we need to add on the depreciation costs, so we're looking at 17.4 billion. And then we can add another one onto that, so 17.5 billion to run this company a year, roughly speaking, as of 2019. Now, that's assuming that they don't make any cuts of any kind. But let's say we've got 17.5 billion to run this business, and let's assume then at 2020 they make no revenue, no money comes in at all. Unlikely, they're likely to bring something in, but let's say that it's just zero, nothing coming through. How long would they be able to survive for at that rate? Well, we've got retained earnings, and this is something that's going to really help them out here, is the 26.6 billion that they're sitting on in retained earnings. This is money that they can get into, they can get access to if they need to. Debt levels are already relatively high, so they don't have a huge amount of room to borrow a lot of money. You know, if they didn't borrow anything, if they were debt-free, then they'd have option to maybe borrow another 10 billion, let's say. But if they were to borrow another 10 billion now, they'd be biting off more than they could chew for the size of their business. And to borrow that kind of money when you've not got any revenue coming in is a real risk. It might be something that they have to do. I don't know. But we're looking at 26.6 billion in retained earnings. That's going to massively help them out because that gives them a year. You know, if their expenses are 17 billion a year, let's call it 18 billion, if you will, that's going to give them room because they can use their retained earnings to cover everything there. That means that they're not in the very short term at a real risk of failure of any kind. This is a huge company as well. But with that, you've got to admit that we've got some huge expenses there as well in 17, 18 billion a year. But that's the risk that we would be taking. Now, we can look at the chart, and right now what we do have is a very favourable share price at about £9.50 a share for a company that, you know, as of January, we're trading around £32 to £35 a share. So we're talking about a massive sale on the shares of Carnival PLC right now. You can pick these things up dirt cheap relative to where they are before. And if you're going to look at the pricing's actually in a really good position right now. I mean, you're looking at about a 41% return on earnings for that price. And when you're looking at equity that the company owns, we're looking at about 25.3 billion in equity. So that's assets minus the liabilities that they owe equals their equity, and 25.3 billion in equity. They've got 755 million shares outstanding. So if we do the maths, that works out at about £33.60 per share in assets. And you can buy a share at £9.64. So for every share you're buying at £9.64, you're getting £33 in assets. That would indicate that the share price right now is in a fantastic position, especially with 41% earnings per share on that share price as well. Both of those indicators, pricing indicators, would suggest that £9.64 is a very good price to be getting into a company like this. However, their share price is obviously there for a reason. I think you'd be taking quite a punt in investing in a cruise line company in May of 2020 when we don't know where this is going to go. People have not returned back to normal. We do not know if anybody's going to be wanting or able to travel in the future, and whether or not they're going to be using cruise line ships to do that. And it's very difficult to kind of foresee where this is going to go. And so as an investor, I think you've got to do plenty of research in a company like this. You've got to do plenty of research in this industry. You need to know this industry pretty well, I would argue, as well, if you're going to be an investor in this particular company. Price-wise, you're getting the price looks very, very attractive. And so when I'm looking at this as maybe a 10, 20-year hold, because I think if you're going to be an investor in this company, you probably got to go through a bit of pain over the next few years before you start to come good, before you start to see some real returns on this. But the potential here is pretty big. The potential here of Carnival PLC's share price being higher than £9.64, let's say, in 10 years' time, probably is quite high, I would argue. And so there's potential here for sure. Listen, I always say this on pretty much every show. You've got to do your own research and don't just take my word for it. I'm doing these videos and looking at these numbers for me, and I'm very tempted to take a punt on this, but they just don't tick all my boxes, and I have enough opportunities in front of me elsewhere where I feel more confident about my decision making within those companies that would lead me to staying away from Carnival right now. It's not necessary for me to take this opportunity, to take this punt in this company, and it's a risk I don't need to take. So let's go and take a look at the leaderboard. Okay, so a couple of things to just cover before we chuck them up on the board here. There is an investigation outstanding at the moment with Carnival, where some shareholders have essentially tried to sue Carnival for their losses as a result of this, claiming that Carnival did not release and therefore misled investors with some of its financial figures and the way it reported some of those figures. Now, I don't know the ins and outs of that. The information is mostly public and you can go and do your own research there, but that's something to bear in mind, something you might, if you're looking at investing in this business, in this company, that's something you might want to look into just to check whether or not there is actually anything going on there, or whether or not it's just sour grapes on behalf of many shareholders out there. It's hard to tell, but like I say, if you do your research, you'll probably be able to find out. They've also announced that they're looking to open some cruise lines in the USA from August, which sounds like good news. However, August is a fairly long time away. We're talking about another 3 months away before they start opening cruises in the USA alone, and that's Carnival Corp, that's the US arm. And so the question there remains, how's the UK side of things going to do, and how long is it going to be before they start things up on that side? And if nothing's going to happen till August, we're looking at pretty much 6 months plus of complete inactivity with this company, which is going to be quite substantial in terms of expenses, in terms of costs, with no revenue coming in. And then obviously, like I said before, the question is going to be, how long will it take before they start to see the numbers of passengers and travellers on these services going forward? They've also announced that they've taken, and they haven't reduced the numbers, but they have reported, and these were their words, that they've taken a huge hit from the virus outbreak. So, like I said in the actual financial analysis, you're taking a risk here, of course, taking a risk with every investment, but this is a risky investment, I would say, in the present conditions, in the current environment. However, despite that, up until leading to the outbreak, this is a company that have done pretty well. They're a pretty decent investment. They're not the best by any means. There are some smaller concerns within those numbers that we saw. As a result of that, it knocks their score down a little bit. The score is the score attributed to the financials that we've just looked at that take us up to 2019. This does not take into account anything with regards to the outbreak and the issues that they're going to incur as a result of that. So the score is going to be kind of pre-outbreak score, if you will. And it's the same with all of these companies, because we just don't have 2020's data, of course. We just don't have the financials yet. Many companies still haven't released any financials around how badly they've been hit by the virus. But let's get them up on the board. So Carnival, or CCL as a ticker code, have scored 54 points. So they are certainly not up there with the best. Not a company I'm probably going to be investing in. The only thing that entices me is that share price. This is a company that, based on the financials, are sitting around 10th place on my leaderboard. They're a very average company, okay, profitable, doing all right, but with some underlying issues there. Certainly not as good as some of the other companies I found. What's enticing here is the current today's share price, which is at a dramatic sale price, I would say, going all the way back to their 2001 float price. So for some investors, this might be a cheeky little stab at getting a decent company at a nice cheap price. Let's get them up on the board. Okay, so holding a nice decent 10th place, they're certainly up there with some of the better companies that are available to us as investors as a long-term investment. And to have 28 companies up on this board and to be sitting in 10th shows that, they're up there with some of the better ones. Certainly not one of the best, but a lot to think about. This is one of the companies where I absolutely highly recommend some strong research to be done. And then from there, you take whatever risk you will. Thank you so much for watching, guys. I hope you have enjoyed the show, and I'll see you guys next week. Cheers.